Our societies and economies have been permanently distorted, according to our next guest, Dr. Nomi Prins. She is an economist, geopolitical analyst, financial journalist, and author of several books, including Collusion, How Central Bankers Rigged the World, and her latest book, which we'll be talking about in great detail in this interview, Permanent Distortion, How the Financial Markets Abandoned the Real Economy Forever. Nomi has previously worked at several prominent financial institutions, including Goldman Sachs, Bear Stearns, and Lehman Brothers, so she has an inside track on exactly how Wall Street thinks. We'll be talking about the latest developments in the markets, what's happening in the UK, the turmoil in the gilt market, and of course, back home in the US, what the Federal Reserve plans to do next and how monetary decisions will impact the financial markets at all levels. Nomi, welcome back to the show. Welcome to Kitco. Good to have you on as always.
Thank you so much, David. Always great to be on the show. Thank you.
Last time we spoke a couple months ago, we talked about the Federal Reserve and their policies, and we'll touch on that again this time. We're going to talk about your book, the main themes of your book, including why you think inequality is perpetuated by not just social issues, but also by the Federal Reserve and central banks. But first, let's talk about some topical news that's hitting the world, in particular across the pond in the UK. Now, as of today, on Tuesday, Rishi Sunak was officially appointed the Prime Minister of the UK. On this day, the gilt yield dropped by 4.5%, so a big move today. And of course, as you know, with the yields dropping, the value of the gilt rose. What does this signal? Does it signal confidence in the British Treasury, or does it signal perhaps lack of confidence, which is why people are rushing to a safe asset like the gilt?
It's a really good question. I think the initial reaction in the UK is relief because although the prior PM, Liz Truss, was only in for about 6 weeks, tumultuous 6 weeks, the fact that Sunak's coming in now is giving the markets, and I think to an extent, just in this very brief period, the Parliament a little bit of a just relief moment. I don't necessarily think that's going to be what happens going forward, depending on his policies, but certainly that relief has occurred in the gilts, it's occurred for the pound, and it's also occurred for the FTSE, for the UK stock markets.
Right. Let's rewind a few weeks to when Liz Truss was still Prime Minister. Now, on the 22nd of September, huge volatility in the British markets on all fronts. So on the FX front, the British pound fell dramatically vis-a-vis other currencies. The British gilts fell in value. The gilt yields rose on that day. And of course, the FTSE index, the British stock index, fell dramatically on that day as well. Now, two things I could think of may have contributed to this volatility on that day. The first is that the Bank of England raised their interest rates to 2.25%, and on the same day announced, very uncharacteristically of a major central bank, they announced that the UK is in a recession. Typically, central banks don't publicly give bad news. The second thing is that then Finance Minister Kwasi Kwarteng detailed close to £200 billion of new fiscal measures, including tax cuts, energy subsidies, and planning reforms, which may have contributed to negative sentiment in the market. Which of these two things, the fiscal or the monetary sides, had the greatest impact on market volatility in the last few weeks?
Well, I just want to throw a third thing at you, which was that one of the things that was happening in the backdrop was the UK pension fund system was looking at an over-leveraged situation with gilts. And to put that into really quick perspective, the pension funds in the UK invest quite heavily in gilts. And it has turned out they also leverage those gilts quite heavily. And so with gilts coming down in price, i.e. yields going up, because rates are going up and the expectation is that rates are going to continue to go up, that created a situation where there was a shortfall in sort of the return from gilts and also in the increase in price to margin those gilts. And so the Bank of England had to announce that it was going to step in and potentially purchase or do quantitative easing for up to £60 billion worth of gilt. So there's a lot happening here. And just to put that into perspective, the UK, the Bank of England is raising rates at the same time they're buying bonds. So there's a kind of bipolar situation going on there between a QE QE, which is kind of a loose monetary policy like thing, and a tightening policy like thing, which is raising rates. And that was specific to the pension funds. The other thing that's happening, yes, there is an energy crisis going on in the UK. That's not going away. Energy problems are already filtering into small businesses and people. That's not going away. The problem with tax cuts being thrown into that is that we have a situation where the economy isn't really growing. As the Bank of England said, it's potentially in a recession. There's an energy crisis imminent, and all of a sudden you're having less tax revenues come in. And that announcement was made by the Truss Parliament or government very, very quickly, and nobody really expected it to be that much and that quickly. All of that created uncertainty. So now that that's been walked back, I think that's what's creating this calm now. The Bank of England's in there to buy bonds. Yes, rates are going up, but tax cuts aren't going to be quite as much. And so on average, there's a bit more of a stability at the moment in policy across all those avenues.
Don't financial markets typically like tax cuts, though, Nomi?
They do, and that's one of the things that I think Truss's team or her very shortly lived team wanted to take advantage of that potential. But when they don't like tax cuts, when there is not enough revenue coming into the budget to meet things like an energy crisis and energy price problems and putting in caps potentially for individuals and for, because this is I was in the UK during the period when Truss was actually appointed, when she met with the Queen right before the Queen died, when the Queen died, when the King came in. I was actually there that whole time, and I can tell you that the number one problem that was faced by everyone in the UK was related to energy and the energy crisis. And so tax cuts weren't really a solver to that particular issue, and in fact put less money into the budget for that purpose. And so that's one of the reasons why it was such a shock to think about them during this period for the markets as well.
Just another note on the tax cuts here. This leads to your book, which we'll touch on in greater detail later on in the interview. But the IMF actually came out with a scathing critique of Kwarteng's tax cut plan, calling the tax cuts very unfair. In their words, it will likely increase inequality. Is that a view that you share?
Well, yes, because what we're seeing right now, and it's not just in the UK, this is in the US, this is really throughout the developed world, is that in the period of time, particularly since the pandemic, when economies were closed, people were, anxious, all sorts of things were happening, and we had all this stimulus from central banks and everything else. What happened was corporations, the heads of those corporations made even more money. Yes, the markets are off for different reasons, like rate hikes now, but that's what was happening, and that created more inequality to begin with, because all this money that was being created, the lower rate accessibility to lower rate money by corporations and banks was exacerbating inequality. And tax cuts you throw in on top of that, when we're looking at inflation, we're looking at recession, we're looking at an energy crisis, not just in Europe but throughout the world. We're looking at geopolitical tensions. It's not something that should be done right now, and it is something that causes more angst, and rightly so, to people who are looking at their governments and saying, you can't even afford what's going on right now. How could you afford it when there's less money coming in from corporations paying their fair share?
Okay. And in your view, do you think that is this something that the fiscal side should take care of, or maybe the central bank should partake in cleaning up the mess? How should the governments fix the budget deficit issue that they're currently in?
Well, I think, again, there's a lot of different issues. With respect to energy, I do think there needs to be help on the lower level of the economy. With respect to the rest of the budget, there's a problem that it's very difficult on both sides right now, and that we have an extreme amount of debt throughout the world. The United States has $31 trillion of debt. That's compared to $9 trillion of debt before the financial crisis, in 2007, 2008. Central banks, including the Fed, have manufactured a lot of money to take some of this debt out of the market. And that's one of the reasons they're holding on to those books. So from a fiscal government standpoint, what I think should be happening is there should be a recognition that inflation is something that actually, particularly in supply chain related inflation, food, fuel, et cetera, is not something that can be fixed by central banks without causing a tremendous punch to the real economy. Yes, central banks can raise rates to tame some of it. For example, bring some of the housing prices down, but that also creates a situation where renters have to pay more for rent because they can't afford to buy houses because interest rates have basically doubled for mortgages in the last 6 months. Right. So that's a problem for the overall economy, as is food and fuel, which is something that I think needs to be looked at by the government. I think central banks also need to decelerate their pace of rate hikes and also explain which part of those rate hikes are actually hurting the real economy, which parts cannot actually contain the inflation that the real economy is feeling. And I think overall, from a governmental standpoint, and just from a business standpoint and an individual standpoint, we need to consider actually helping the real economy, actually building, actually producing, actually creating better infrastructure, all the things that were on deck before the Fed and other central banks started raising rates, because ultimately we need to bring the economy up to the level of a transparent market and not have it lag and not have inequality increase behind that.
Here in the U.S., we're looking at the Bank of England as perhaps an example of what a central bank may do that is sort of on the heels of a pivot. Like you mentioned, right, they raised rates in September, but at the same time, they've resumed their bond purchasing program, which is kind of a dichotomy. The Federal Reserve's not doing that. So let's just take a look at the Bank of England first, and then we'll come back to the Federal Reserve. What do you think the Bank of England is going to do next at their November meeting, which is coming up in a week and a half? Nomi, are they going to raise rates again, or are they going to pivot?
I think they're going to raise rates again. I think they might come down on the size of the rate hike. I think they might do a 50. But I think that all of central banks, and this is because of really the Fed's language, have had to be in this role of, quote, fighting inflation without distinguishing all the different kinds of inflation. And again, noting that they cannot fight certain kinds of geopolitical or supply chain related inflation. They can't fight what natural gas is going to cost, how that's going to feed into electricity and everything else by raising rates. In fact, it's just going to make it harder for people to pay their bills. But I do think that the Bank of England and the Fed, they're in the middle of this language. They're just to enter what I call a three-stage pivot, the three stages of which will be to reduce, decelerate the pace and the size of those rate hikes, then to go to neutral, and then potentially to cut if we do see more of a slowing economy going out for the next year and a half. So I do think these things happen, within the next meeting versus a year and a half towards, getting real cuts. And then that's because of what's happening in the real economy. But again, first lower hikes, then neutrality, then potential cuts. I think with the Fed, one of the things that the Fed said it would do is roll bonds off of its balance sheet. And it's been doing that at a far slower pace. While it's kept the pace of rate hikes up, it's rolled bonds off of its balance sheet at a slower pace than it had said it would do. I think the reason for that we have just seen in the UK. It's not necessarily because it will hurt the pension funds in the US, which, by the way, are also heavily invested in treasury bonds. But it is also because the more that they actually let roll off from their quantitative easing policy, the more it's going to hurt the bond market. It's going to hurt the cost of furnishing that debt from respect to the U.S. government. That's going to hurt the budget. That's going to hurt the deficit or increase the deficit. And all of that is something that, being here in Washington is something that's politically on the table for the Fed, which is supposed to be an independent body, but has to recognize there's a political cost and there's a budget cost, there's a deficit cost towards not keeping the pace that they said they would keep of reducing the size of their book. Can they do what the Bank of England did? Can there be a situation where they're raising rates, but they're also potentially doing some quantitative easing or quasi-quantitative easing with, for example, Wall Street, the repo markets? Absolutely, absolutely they can, and I think they will.
Is it possible for the Federal Reserve to do something similar to the Bank of England, which is to raise interest rates at the same time as quantitative easing or a bond purchase program? And if so, what would happen to the markets?
Well, that's exactly one of Wall Street's potentially positive scenarios, right? Because it's making money on the rate side in terms of requiring more payments from their customers, whereas they're getting liquidity themselves in a different way, more cheaply through whether it's quantitative easing or the Fed acting more in the repo markets or whatever it might be, as we saw them do at the end of 2019 when Wall Street was facing a liquidity problem. They didn't call it QE, even though they raised at that point the size of their book from 3.7 trillion to 4.1 trillion before the pandemic even surfaced at all. And then, of course, they more than doubled the size of their book after the pandemic sort of surface. I think those sort of behind the scenes movements are potentially likely. We heard the banks, when they reported earnings just recently, predominantly say they're going to have to put aside more money for loan loss reserves. What does that mean? That means that they're afraid there might be some delinquencies or defaults. That decreases their liquidity, and that requires potentially the Fed to come in and do something a different way, not necessarily lower rates. Again, that's not happening as a first move with respect to Wall Street, but potentially figuring out some way of injecting liquidity into the system in a QE or quasi QE way, as they were shown to do in the end of 2019.
You mentioned energy crisis several times in Europe and in the UK in particular. Back home in the US, we don't really have the same kind of energy crisis right now, but there is a diesel supply crunch. According to estimates, there's only 25 days left of the national diesel supply, and the government is running out of options. Is this a concern for you? I mean, what's going to happen to inflation?
Well, this is going to be part of what pushes up or keeps up that side of inflation, which is related to sort of the reality of supply chains, which is the food and fuel side. Diesel is used by trucks. Trucks are used to transport food. If it costs more to transport food, which is already high, then sort of the consumer retail outfits, your grocery stores are going to have to put up prices. That's going to create more inflation. And what we're seeing now is this weird scenario. Not weird, but I mean, people. We haven't had this scenario in decades, which is that people are buying. They are still buying at higher prices, which looks like they are keeping up with inflation, but in fact, they're buying the things that they actually need. And needs like for food and fuel are not necessarily going away just because the costs are higher. People are just being more stretched between what they're getting paid and what they absolutely need to buy. So diesel is a problem, but also our electricity prices. We do run substantively in this country, different in different states, but on natural gas, and our natural gas reserves are also limited, as they are more so in Europe and in the UK. And this is pretty much a global situation. So I do see, and people already probably have seen this, electricity prices for people going up more so in the winter than a normal increase in the winter. And this will also feed into inflation, but again, not the kind of inflation that the Fed can really do anything about, even though they talk about inflation as sort of a blanket statement.
I think that's the key point, what you just said. This is the kind of inflation that the Federal Reserve can't really do much about. In other words, it's supply chain driven inflation. So by that logic, Nomi, does the Federal Reserve need to even raise interest rates beyond what they've already done? I mean, think about it. If the supply chain issue supposedly should fix itself down the line, the Federal Reserve doesn't really need to take more punitive actions against the economy now, right? What they're doing is just going to worsen the economy, which may exacerbate supply chain issues.
Well, that's exactly right. Or certainly exacerbates inequality issues and people's just ability to stretch their paychecks and their household budgets. And that is a problem because the Fed cannot impact really fuel and therefore food prices, which are two basic items. They also haven't been able to do anything to even impact, for example, rent prices, because as I mentioned before, raising rates so quickly has created a situation where people entering the market really can't, and that might bring some housing prices down, but it's also increasing rent prices, which also goes into large inflation numbers. So what the Fed is doing in general is it is hurting the people at the bottom of the economy. I believe they should stop, wait a minute, and just sort of see whether what they have done actually is really hurting the real economy, and acknowledge whether it has, which they haven't done. They just talk about the labor market being hot, wages being too high. The reality is wages haven't kept up with these inflationary prices on real items that are needed by people. So I think they need to acknowledge what's actually gone on. I don't think they'll do that at the November meeting. Or if they do, they won't necessarily have that be changing what they decide in terms of a rate hike of a 75 basis point hike potentially then. But I do think we might see some language from some of the Fed governors, not necessarily Powell, because normally recently he's been a bit more sort of strident in his hawkishness. But I do think we'll start to see some language coming in about the real economy, potentially waiting to see how data comes out, what happens with inflation. We're not going back to 2% inflation anytime soon. And so this policy, this accelerated policy, the Fed isn't really changing that.
All right, I want to finish off on your outlook, and then I want to talk about your book. Very interesting read. So when do you think the Fed could pivot?
Well, again, in terms of a three-stage pivot, I do think that their last hike of the year will be lower than 75 basis points, but it will still be a hike. Okay. I do think, I think that sometime in the first half of next year, they're going to go towards neutrality. And then I think in the second half of next year to the beginning of the following year, I think we're going to see potential cuts, because I do think that the problems that are happening for the economy right now are going to be building up over this next year period. And that's going to require the Fed to come off of what will be significant rate levels at that time.
Mm-hmm. Now, you've worked in major investment banks in your career prior to your current role as a freelance journalist. Now, so you have an insider's take on what Wall Street does during periods of financial distress. What do you think the major investment banks right now are doing in anticipation of a worsening economic outlook, in anticipation of Federal Reserve actions like you've just pointed out? Jamie Dimon, for example, previously said that the economy was doing just fine, just recently changed his tune, said that there will be a serious recession in the next 6 to 9 months. What is Wall Street doing right now, Nomi?
I think to a large extent, Wall Street's sitting on cash. Obviously, we have seen markets come down in levels of the stock market and prices on bonds as rates have risen, and as there has been this uncertainty as to what the Fed and other central banks are going to do next. And I think the fact that Jamie Dimon is coming out now and sort of changing what he said before is potentially both preempting and hoping that oddly, that the Fed will see that there's been economic weakening to an extent that it has to basically back off. I think at that time, as we've seen happen in the pandemic period, the financial crisis period, and throughout this period of significant loose monetary policy on average from central banks, I think that Wall Street's going to sort of jump back in. And I think that all of these sort of, particularly the names that have fallen off so badly, whether that is in tech or new money and those sorts of, sort of more speculative, more risk-on type items, I think those will ultimately be the beneficiary. But I think in that between now and then, I think we see supply chain related materials and necessities actually preempt what could potentially be a rally back then. So I do see metals, I do see infrastructure related type of items being things that can absolutely rally, that Wall Street is looking towards in the commodity sector as a sort of midway to that point. But
the tech sector and everything else?
I think that will come about sort of once we know that the Fed has become neutral. Right. And that will be connected to when really we do have a significant slowdown that the Fed actually recognizes as an economic slowdown throughout. So I think we have a bit of a wait until those things come in. But I think in between that period, as the Fed backs off of rate hikes, but we still, or the pace of rate hikes, the size of them, but we still have a situation where there is inflation. I do see these commodities being the place where, and the energy sector being the place where Wall Street puts its money.
My next question ties into your book because you do outline your expectations in your book for what the economy is going to do in the future based on, a lot of historical precedents. But several people have commented to me, Nomi, that this bear market that we're in could last several years, if not a decade. It could potentially repeat 2001. Remember, in 2001, the NASDAQ collapsed following the dot-com bubble bust, and it did not recover to its previous 2000 peak until later on, I think 15 to 17 years afterward. Could this happen again this time, that we won't see another high for another 10 years or so?
I don't think so, because we are coming at a position right now which was different to post the dot-com bust, and there were certain names in that period Sure. that did quite substantially better than the rest of the market during that period, notably Amazon and other names. But we're in a situation now where central banks have kind of been unleashed. And though we are seeing this tightening right now in response to inflation, which again, as we talked about, isn't necessarily all under their control, we do have an environment where we've got multiple trillions of dollars worth of a cushion to the markets that have been created by the central banks, that have taken debt out of the market, and that continue to be there sort of as a life raft for a trampoline in a way for the markets. And those sort of piles of debt, sort of stashed at the central banks in return for injected capital into the system still exist. That wasn't the case back then. And so I think there's just a lot more because this is where I get it. I talk about this a lot in Permanent Distortion in my book, because that mentality has become normalized. Even though right now we're raising rates, it's important to look at this particular period as just part of an overall multi-decade period. But as we noticed in the pandemic, if the central banks want to double the size of their books, they will. As we noticed in the UK just recently, if they want to create 60 billion pounds worth of money to help out the pension fund, they will. Yes. So there is a situation now where central banks have more of a sort of magnitude and an ability to create money. And I think as a result, that money is in the markets and can be leveraged into the markets at the point at which there's more certainty about their policy decisions.